is there anybody on the call or in the room here that is familiar with Pompano rentals? Anybody got a ballpark idea?
Yes.
What would a 4-bedroom here? What would this property? Let's see here, 2611 Northeast 8th Terrace.
Is that Crest Haven?
So what would something like this rent for in Pompano? Says it's it was just a random one I picked. I had no research whatsoever. I just picked it up. It's let's say it's a 3-bedroom. Oh no, it's a 4-bedroom, 4-bath, which is hard for me to believe. Yeah.
You can see they enclosed the garage. There's a bedroom, bathroom, 30, 31, depending on what section 8 you're paying.
So 3,100, right? All right. So you're gonna love this if this is a $3,100 rental. I'm telling you. We come over to here onto this sheet, and I just took the information. I personally put the ML number so I can keep track of it. Single family. 375,000 ask price. It's been on the market for a few weeks. 20% down. Closing cost 12,000. All sound within reason, folks?
Rob, can I make a request that you make that on the full screen, because I'm getting everybody's picture on the right and the.
I think that's on your end, Eric. You just have to make it full screen for you.
Oh, really? Let me check that out. Yeah, you may be right. Okay, I got it. Thanks. Sorry.
Improvement costs. So let's just say you buy that property, you got to drop in 10 grand to get it up to snuff, right? It takes you 2 months of carrying it to get it rented out, right? All sound reasonable. Take a mortgage at $300,000. Interest rate 7%. Any lenders on the call here? Frank, are you on?
Yes, that's about right.
Okay, so we do a 7%. Annual maintenance fee. I took a percentage for what you'd have to spend to maintain the property, taxes, insurance, rent increase. This is 3%. Appreciation rate 5%. Monthly rent 3,200. So this particular property, if you invested 75,000, 10 closing, 12 closing, 10 carry, and 6,000 to get the property ready, would give you a, well, my formulas are messed up here, but I'll fix them. So it would give you a monthly cash flow of minus B23. B23 is the total expenses. Total expenses is principal and interest is not right. So principal and interest.
Rob, can you make it bigger, the spreadsheet, please?
Yeah, let me just put the formula in here. Hey, Fred? Fred?
Yes.
There was a formula in here for the principal and interest before. You want to go back to an older, go back to an older version and put that in because it worked. Okay. So what Fred's going to do is he's going to go.
I got it.
Okay, you got it?
Yeah, I got it bigger. Thank you.
Okay, so Fred, you put the formula for principal and interest. It's going to be payment, and I put the formula in there for you. So automatically calculate what the principal and interest is. And we're going to come up with two numbers. Okay, we're going to come. Yes. Okay. Oh, yeah, it's way low, right? It's like 4,000.
Yeah, 4,000.
And that's going to automatically adjust through. 4,000 taxes are, so it's going to be 8,400. So it's $705 a month. No, that's actual taxes.
That's what the current sellers pay now.
Okay.
Purchase price times 85% times 2% will get you almost exact within a few $100.
Okay, so I can build a formula in for that, and I can give you all this spreadsheet, and we can show you how to make this adjustment. So it's going to be automated. This is great content here and talking about what's going to happen after they buy it. But this was just me Googling a property in Pompano. There was no research whatsoever, and it looks like it might even be a viable investment, right? And the numbers that we're going to talk about, your cash on cash return and your cash flow, and then the cap rate. Has anybody dealt with investors? Any other terms that they ask you about that you might want to have me clarify here and shed light on? Because it's really not that complicated. Huh? What's it called?
Gross rent multiplier.
Gross rent multiplier. I've not seen a whole lot of people look at that, but so what they're just doing is they're taking the gross rent, they're multiplying it by a factor, and they're saying this is how we value the property. Yeah. So this is going to be, in my opinion, is going to be a much more fundamental way of evaluating properties, because the gross, that's just like a ballpark. This is giving you the meats and bones, right? So if you're looking at 10 properties, you can use the gross rent multiplier and you can eliminate 5, but this will tell you what your real return is on it. So cap rate, you also want to look at cap rate. I think for the regular investor is overdone. Okay. I think the regular investor is going to be, if I can get you, Lauren, if you had 110,000, okay, I can get you a $24,000 a year return on that, which is a 17.5% cash on cash return, right? Because if you come up to me with $112,000, right, and I give you $24,000 in annual return, that's your cash on cash return from year one, right? Does that make sense? And if we're talking to the premise of this was to talk to our clients, our current buyers, sellers, sphere of influence, reach out and say, hey, by the way, you had any thoughts about investing in real estate? If you had, I'd like to give you some information about what it looks like. And for me personally, and I'm speaking for truth, the stock market to me is foreign. I don't understand all the stuff that happens behind the scenes there, right? One day my stock is worth $300 and 10 months later it's worth 120. That's my Tesla share. So I'm like, I don't really love that. Right? And my Zillow stock had repeated that process a little bit earlier. So for me, like, I thought it was good. Like it was at 150, I bought it at 60. I thought I was getting a bargain, right? Carlos, where's it now? 30s, right? So Carlos copied me and he unfortunately used the same flawed logic. But if you buy a piece of real estate, and does anybody in this room think rents are going to go down in 1 or 3 years from now? Is there anybody that wants to press me on that? You think they're going to go down? So we have 1 out of about 15.
It's soft.
Yeah.
So
It's been like this and I know.
Baby.
okay. So I bought a property in Fort Myers. I paid $400 for it, put it on the market for $3,000 rent. I had people running me over. They bid it up to $3,200. In my lease, I put it's going to renew at 5% above or the CPI plus 2%. Okay. They just renewed it. I just gave them the CPI. Maybe I'm a fool, but I was like, look, you 7.1% CPI. I'll give you an option to renew it at 7.1%. And they were like, yep, we're done. We're doing it. So I got a 7.1% increase. Consumer price index. Okay. So couple of things that I want to talk about here, and we have a full hour reserved here. And for everybody here, and if you have online, I'll stay for more questions.
Lower means buying it cheaper.
Fred, did you get the formula put in?
7 acres, you could put a house per acre. Yep. How do we make this
Fred,
attractive while
Fred,
still making
Fred,
guys?
go to an
So
older
we
version
said
and
market
7 acres.
Roseland.
Could
Oh,
be if
that's
you-
Mr. What's his name? Yeah.
We're meeting with him in an hour.
You don't want to do 7 acres there. Can you do towns?
No.
You can't do towns.
Okay, I just muted everybody. So Fred, if you can go to an older version and then just put the formula in and then carry it across for me, please.
Okay,
All
hold
right,
on.
thank you. So, couple of things that I would recommend because I've owned a lot of property and experience is the best education you'll ever get, right? So if you do a rental, when they're signing the lease, are they generally concerned about what the renewal is most of the time? Not at that point, right? But if you don't put it in there, like they called me up, they said they want to renew. I said, let me pull up the lease. I'll tell you what the renewal is. It's the higher of, and I did the higher of 5% or the CPI plus 2%. And honest to God, I just told them like, just give me a 7.1% increase. I'll be happy. Don't have to turn it over. Don't have to do anything. You pay me on time. Is that a good deal? Okay. And the property that you bought, Carlos, that I showed you, right? You have a 15-year mortgage on it. What's the mortgage payment approximately? $2,000 a month. And how much rent are you getting for it? $4,400. You have a 15-year mortgage. We got you on that. So he got a 15-year mortgage about a year and a half ago. It's amortizing over 15 years. The payment is $2,000 a month. The rental income is $4,300. 4,400. And this man over here said, Rob, that was really a great tip you gave me. My account built up to what, over 30,000 in a year? So he has over $30,000 of cash flow in that account, and the purchase price was what, 350? 330, and you put 100 into it. So it's a 430 investment. You have a $30,000 cash return from January till December. You have paid off probably 12, 15,000 of debt in that property, right? And I'm going to laugh at this, but how much has that property gone up in value? 600. So that this is the way the game works. Is it's about, when I was talking to Carlos, I'm like, look if the property doesn't appreciate in value, you're in good shape because you got almost 2,000 or more than 2,000 positive cash flow. Okay, you're paying it off in 15 years. You're a young man. By the time you're ready to retire, that will be a free and clear asset, and you'll have made money during the process. Like, what's better than that? And I did that property for Carlos. It was probably 2 years ago when I was doing a presentation to the group about how to analyze properties. Now, I know Pablo's on the call here. I tried to do an export of the entire MLS result here. It wasn't as easy, but I'm sure I can figure out a way to do that. Or you could take the top 25, right? Just copy, paste, and then take the top 25, bring them down to 7, put them into this sheet, and talk to your clients about it because these are good investments. All right. And this is, a blinder on throwing a dart at it. Fred, are you making any progress with getting that corrected?
That is the correct formula. The
It's
one
not
that
the
we see
correct-
right now.
No,
Click on that.
there's no formula here.
Yeah, there is. You see?
No,
Click on that.
it starts with payment, Fred. It's payment equal, it's this payment. And then it has parentheses in it. That's how it works. And the payment's going to be like $2,000 a month for principal and interest. So this sheet will tell you the major components of investing in a property. So what are the major components when you're looking at investing in a property? Somebody said cap rate, right? You said gross rent multiplier, which I'm not a big fan of. That's like taking 50 properties, lowering it. Well, no, and I'm not being critical at all. Please understand. I'm just trying to say the gross rent multiplier is trying to take the 50 down to 15. Okay, what else did we talk about? Cash on cash return. When you own a property and we're going to talk about cash flow, right? There's a positive cash flow, which in return affects the cash on cash return, right? What other things are we going to look at in a property? So if we have positive cash flow, a cash on cash return, if we get if you give me that $112,000 and I give you $24,000 over the period of a year, and let's say that's an 18% return, who thinks that that's a pretty good return? Huh? You'll take it.
Absolutely.
Now I'm going to do like one of those TV guys, but wait, there's more. And Lauren, you're taking notes. I would advise everybody, if you want to take some notes, get a piece of paper, because it's really simple and it's an easy conversation to have. And this is designed to be had with the person that you sold their second home, the person that is looking at buying an investment property like a one-off. We're not talking about the commercial investors that Michael Eisner works for. This is like really basic stuff. So you have the cash on cash return, you have the cash flow, you have the appreciation rate, right? Now, I'll bet you if I asked everybody in the room, a year from now, is there anybody that thinks property values will be higher than they are today? Anybody? I have one, so two. So we're the opposite. Before we had one person that thought rents might not be higher. We have two people now that think property values will be higher. Who thinks they're going to be similar to where they are now? Raise your hand. And so we have probably a third of the people think it's going to be similar. Who thinks there's going to be like a 0 to 7% reduction? Who thinks there's going to be a 7 to 15% reduction? Who thinks there's going to be more than 15% decline? Nobody. Now, if I reframe that question and I say, 5 years from now, you come back here, would you rather buy the property today, or would you rather take your chances and see what it's in 5 years? Who thinks 5 years it's going to be less? Anybody? Who thinks that the property, if you buy a property today, in 5 years it will be worth less than it is today? That is a tough question, right? Let's take a look at Apple stock. So Apple stock, pretty good. Take a look at Amazon stock. Okay, is Amazon stock a pretty good stock, right? Now, if you bought the stock over here, you might have to wait a little while before it goes. But stock, it goes up and down over a period of time. We expect this asset to appreciate. What you think doesn't really matter, does it? It's what they think, right? And the more you try to convince them, the more they're zoning you out. So if you were to ask 10 people that you have conversations with, and this goes to the gentleman that drove up to my office in Morristown and said, Rob, I have to share with you, this is a change in my career here. It's going to go from 510,000 to over $1 million, he says, in commission in 2023. And he wanted to have me know about him making that claim so I could hold him accountable. But he specifically didn't want me to share it with everybody on the mastermind because he'd feel embarrassed if he didn't make it. So that's the full disclosure. But he said if he has 10 conversations a day, which means he's talking to 10 people that are in his sphere of influence, that are people he attempted to sell a property to, a property he sold to, okay, that whole group, if he talks to 10 of them, he's like, Rob, 2 to 3 people every time express some level of interest. In the beginning, he actually invited people over to the office and did a little class on it rather than do it, 10 times individual. He's like, look, come on in on Saturday. I'll bring in bagels. We can have a discussion. 10 people said they were coming. 3 only showed up, but that's still better than nothing, right? And he says that he's going to do 2 to 3 transactions each and every month. So I feel passionate about sharing this with you. And the whole purpose of it was really simple. Most people have an investment horizon of 5 years or more in real estate. If you don't, probably not the right investment for you. Would you all agree with that? If you're going to invest and hold it less than 5 years, And if your client believes that it's going to go up in value in 5 years and you're making money along the way, that's the cash on cash return. If you put down 20% and there's 2% appreciation, what does that do to your return?
2% appreciation of the value.
So let's do an exercise, right? So if you buy a property for 100,000, right? And you put down $20,000 and the property appreciates 2%. What's 2% of 100,000? 2,000, right? 2,000 divided by 20,000 is extra 10% return. Okay, that's massive, right? Now, wait, there's more. Oh, for real. So if you go and you earn money, right, and you make $100,000, what type of tax do you pay to the federal government if you're in Florida, and the federal and the state if you're in New Jersey? You paid earned income tax, right? Which is probably 33%, maybe even a little bit higher than that. Now, if you own a piece of property for 5 years and then you sell it for a profit, does anybody know what that's called?
Capital gain.
Capital gains. And does capital gains get treated better or worse than ordinary income? Who knows?
Better.
So if you're over a year, it's capital gain. So I don't know of any circumstances where a capital gain would be treated worse than ordinary income, right? So if you made $100,000 profit on selling a piece of real estate, you're going to pay less tax than if you went out and you earned $100,000 in commission.
Correct.
You could do
So-
a 1031 exchange and then defer.
Yeah, but
Capital gains.
you're splitting the atom. Whoever said that, we're keeping this simple for right now, right? So the simple answer is that when you get a profit, it's treated favorably, right? While you're making the profit, okay, you're making that $2,000 a month. The property is going up in value. What does your accountant do when he does your tax return? He puts something. He says you made $20,000 profit, but we're going to do what to the house? We're going to depreciate it. So guess what, Lauren? You made 20,000, but you know what? You don't pay any taxes on it.
Not correct.
So this is why our agent is having so much success, because it's a great story. And literally the property that we reviewed a year and a half ago, 2 years ago, on this same exact format, he went and sold it the next day, and he could have sold it 5 times over because, like, look, it was a townhouse in Powder Mill. You know, it had a very clear return. It had no exterior maintenance, right? Very predictable rental income. They all rent, like, all the 3 bedrooms rent within $100 of each other. And he could sell that over and over and over again. So if you go and you do this in your market, you can have 3 or 4 properties to talk to people about. Say, hey, if you want to buy in Delray, you want to buy in this town or that town, I have 3 properties that I reviewed. You know, if you're interested, we take a look at it. They may not be available when you're ready, but it would give you an idea of what the market's going to provide to you. All right. I know people
Rob?
now. Yeah.
Sorry, I have a question about the whole tax situation. Is there any benefit to LLCing if somebody has more than one or even just one income property in terms of tax benefit?
I'm not a tax advisor. I don't know that putting a property into an LLC has specific tax benefit, but I do think it has liability benefits.
It does have tax benefits as well. Yes,
So-
because you can claim all the expenses if you have it in an LLC.
But you can claim all the expenses without being in an LLC. So I'm not a tax advisor, and I'm not trying to be.
My accountant said that it does not have any tax benefits, just an FYI.
Yeah. So if
Yeah,
you
my
ask,
accountants have said the same thing.
if you ask 3 accountants, they're going to give you 3 separate answers. FYI.
But definitely a liability benefit, like God forbid something happens to someone in one of the rental properties, they can't come after your personal assets, correct?
Yes.
Okay.
Rob,
Thank you.
And Eric, you and Jackie went and bought a property after it too, right?
yes, we did. Actually, bought 3.
So, oh, excuse me. So we had this, Lauren, I'm just looking at you because we had this about 2 years ago, and after this, everybody kept coming to me, is this a good deal? Is this a good deal? And then I looked at the one with Eric and Jackie, and I'm like, I don't see why you wouldn't want to do this. So I knew they bought one, but actually they bought three. So Eric and Jackie, I'm proud of you. I hope that's a tremendous investment. You're setting a great example for your clients.
Well, thank you very much. I will tell you that we were looking at it just the other day. We haven't sold it yet, but we figured out based on what we're looking at here, we made 33% in 2 years, which is kind of crazy, right?
Yep. And then if you hold on to it, you'll make 100% of it because it'll be paid off. Or if you paid cash, then you still have to look at the appreciation and the cash flow.
Well, the rates were better. The rates were a lot better, and we were paying. It's paying off about $500-600 a month in mortgage, which our tenants are paying for, which we like. So that's fantastic, also. And they've gone up about 20-25% in value, which I'm not even putting that in there.
20% appreciation.
Yep.
And how much did you put down on it, Eric?
10% on one, 20% on the other.
All right. So if you put down 10% on a property and it appreciates 20%, what's your return on investment? 200%.
20%, 100%.
200%. That's insane.
That's what it was.
That should almost be illegal, right? Because that's what leverage does for you, right?
Well, listen, property values hold values. It's good, and it's still paying every day. It pays off, which is good. Hey, Rob, can you do me a favor? I hate to bother you. I have to run because I have a meeting. But can you do the 1E where it's mine? I want to see the bottom. I can't see the whole thing. Maybe you explain that. 160 Preston Street before I leave.
Sure.
Thanks.
So Eric gave us a 150. That's the ask price, Eric, or what it would sell for?
That's actually the ask price. I can probably get a little less.
Okay.
Okay. I don't want to say too much about it, but it's coming back on the market today.
So 500,000. If you're an investor, you probably need to do more than 20,000 down, unless you're buying like FHA, which is kind of
my client who's going to act. They were actually going to live in there and rent out one side, but they want to figure it as a owner occupied 2-family, and they're going to pay 1750. Yeah,
perfect. And there's another thing that I want to mention before I go through all this is like in my career, I've met a bunch of nomads who will stay in a property 2 to 3 years, fix it up, make a big profit, have it be their primary residence, not pay any taxes on it, and then buy another one. Anybody ever known any of those real estate nomads? Kind of annoying. They don't pay any taxes. But what a brilliant idea. So this is FHA, 20,000 down.
How do you not pay any taxes?
On your primary residence, you can have up to 250 for a single, 500 for a married couple every 2 years. It has to be your primary residence, Mickey. All right. So
got it.
So initial vacancy period is like half a month. Mortgage 480. Is 6.5% about the rate they're going to get, Eric?
Well, actually, yeah, it was exactly 6.4. Actually, it was under 6 yesterday for some reason. I don't know why.
All right, let's just be conservative. Let's say 6.5. Taxes are 13 grand. Insurance 1,900. That seems a little bit light, but let's even make that 2,500, Eric. It's a multifamily. Annual rent increase is 5%. Appreciation rate. Can I take that down to 2%, Eric?
Sure.
Monthly rent 4,000. Is that what they would have to pay if they paid their own and then they had the other unit?
Together, that's again 2,350 plus 1,750.
Okay, so I'm going to verify these numbers. It's 480, and I'll get the formula fixed. Fred was just doing some work for me. 30 years, 6.5%, 3033, and I'm going to add $150. I'm going to add 200 on there because there's going to be PMI. So 32, 33. It might be off by $50 or $100. Taxes and insurance are going to be 1,000. Insurance is going to be taxes are 1,083, and I'm going to add 200 to that. So I'm going to make that 1,300. Property maintenance, 3%. Total expenses are 46.53. If the monthly rent is 4,000, Eric, you got a loser. You're losing $653 a month.
Correct.
Now, can I make an observation, Eric? Is 2,000 the market rent for that? One of those units, or is that rent that hasn't been adjusted for a while?
That's as is without doing anything. If you notice, I put nothing in for increasing values.
Yeah, so I would say that, you know, probably from an investment standpoint, this is going to take time before it becomes viable. But this is the point of the exercise.
Okay.
All right. And in New Jersey, the challenge that we have is property taxes tend to be higher than even in Florida. We do have better insurance, and the rental rate is good, but it's crazy down here. So this one here, Eric, I would say from a pure investment standpoint would not pass the muster with Rob Lazar. So like it's one of those shows, denied.
Gotcha. Fired.
Okay. So Eric, if you have any other questions, I know you got to run, but this is all recorded, and I'm going to get everybody a copy of this sheet. Okay. So I
Hey,
would
Rob,
say,
will that sheet be live? We can manipulate it?
yeah. So you know what I did? I did it as a Google sheet. I'm just going to share this with you. And the form come in like this. And we had some challenges when Fred was converting it to go over to here. But we don't need, I can make a sheet like this one here. And then I'm going to make it non-editable. And all you need to do is copy the sheet. Then it's yours to own, right? And then what I would do is I would either save the link to my original, or I'd make one original yourself. Every time you work it for a client, you just copy the sheet and you put the client's name on it. You can put the properties in, and what I'm going to do is I'm going to highlight over here, I'm going to highlight all the ones that are input, and I'll make them like a yellow, like this. Look, I'll make it like this. So I'll have a faint color to it. All the ones with the faint colors, you input that data. Everything else is formula driven. So you put the down payment, 20%, it will calculate the down payment amount. It will calculate the cash on cash return. It will calculate everything. You don't even need to, see, I love this. I have a financial calculator on my iPhone. You can get it on iPhone or Android. If you're interested, you know, I'll stick around. I'll show you how to work this. If you don't want to know it, like most of us, you just put the formula in here. But it can answer a lot of different questions. Like, hey, if the rate goes up an eighth, the rate goes down an eighth, you know, after a year, how much principal will I pay down? You know, who can calculate after a year, how much principal am I going to pay down on my properties? Anybody know how to do that? Would you know how to do it with a financial calculator? Yep. So, I mean, it's not as simple as you would think, but we all know in the beginning, you're paying very, very little principal, right? And then that number escalates over time. So what would make sense for, who wants to be a volunteer? I'm going to stop picking on Lauren. Who wants to be a volunteer? Like, what would you have to get as a return on your cash to be interested in investing personally in real estate? Anybody? Yes. 10%.
Wow.
So I will tell you a 10 or a 15% cash on cash return. Probably 10 to 15% of the properties that are listed on the MLS exposed to the world can provide that to you. 10 to 15% of the properties, which is pretty big, right? You think like, oh my God, these are all picked over, right? No, this is a great question. That's a great question. Hold on. So the question was, is that at these rates or the old interest rates, right? So with the new interest rates, that's where I'm calculating the returns. Okay, so what happens if you buy it at a 6.5% interest rate and rates go up to 11? Well, no, if you buy it and you
Pays
fix
at
it in at
6.5%.
6.5%, and the rates go up to 11%, you feel pretty smart, right? Because you're like, I'm never going to pay this off because I got a bargain, right? Now, on the other hand, you take that out at 6.5 and rates go back down to 3. What are you going to do as a property?
Refinance.
You're going to refinance, right? So this is the phrase that I like to share, and you're welcome to steal it. When you enter in this market, there's less competition to buy. And if interest rates were to continue to rise, right, you feel pretty good about locking in a 30-year or 15-year fixed rate at 6.5%, right? And if rates were to decline, you're going to refinance it because there's no prepayment penalty. Now, I call this heads you win, tails you win, right? If you flip the coin and interest rates never go back down, you feel pretty good about locking in a 15 or 30-year fix. You flip that coin and interest rates drop, you get the benefit of the lower interest rate, right? It costs a couple grand. So I think consumers really understand the heads you win, tails you win analysis, right? Because everybody's frozen because of interest rates. But if it makes sense with these interest rates, what is it going to look like when interest rates decline if they ever do? I believe they will, but I can't guarantee it. And I will give comfort to anybody if they say, hey, I'm totally comfortable with it at this. Interest rates fixed. You know, taxes aren't necessarily fixed, but that's going to be minor adjustments, right? Insurance is a little bit volatile, but right now I'd say insurance might over time come down once they fix it here, right? Because there's a structural problem with insurance in Florida. And I think in 5 years, property values will be higher and rents will be higher, right? Because another question that I would ask you, if you're one of the people like, I'm not feeling so great about property value, right? You know, you kind of got bid up and maybe it's going to have a little bit of a correction. So the only way that you have more inventory is you have to build it, right? Has anybody went to buy building supplies or appliances? Anybody been out there to look for building material or appliances? Have they gone up or down?
Up.
They've gone up ridiculously. Now, over my lifetime, and I've been around a while, but not forever. I see stuff goes up quick, comes down slow if it ever does, right? So the cost to replicate and put new inventory in is going to be expensive. So that's going to provide a floor to the value of real estate. Okay. So I'm really convinced, and I did this because I think that we, being in the industry, should be making an extra sale or two every month or every year. Take that money, put it aside, buy a piece of real estate, right? And if that's good for us, who else is it good for, right? Everybody, right? So like if you were selling Tesla cars, right? And you drove a gas Mercedes, you think people would look at you like, why am I going to buy a Tesla from you, right? So if you're going to talk to people about buying real estate, the first person that you need to convince is who? Yourself, right? And if the math is simple, like a 20% cash return, to me is crazy, and there's really very limited risk. Very limited risk. And on top of that, you have tax benefits. Because you're making $24,000, but your accountant's depreciating it by $24,000, and you're probably writing off the expense to go drive by it, you know, and whatever other things you're doing. So there's other inherent benefits to investing in real estate. So I would learn this. You know, I will make this super simple where you just fill in the canary colored pages. You don't have to do the link anymore. It will auto populate it. And like Mr. Funk's, it will tell you it's a winner or a loser, right? And can I share with you some tips that I found in helping Mr. Turner find that property? Okay. One of the things I found was that if you're buying a multifamily, okay, if it has a garage or an ancillary building, that's extra revenue. Okay. Most people price a two-family as a two-family, but if you have a two-car garage that can get you $400 a month, that adds about $60 or $70 or $100,000 value to that property because of that cash flow. That makes sense? And the biggest opportunity is if rents haven't been brought up to market. If somebody's owned a property for a while and you look on the MLS and something that should be renting for 2,500, it's renting for 16, right? They're going to sell it based on the 1,600 a month rent, but who knows the market? We do, right? So for us, it has more value than its performance as it is today, right? So honestly, if you can just take a little bit of time, if you can learn this, if you can have it as a conversation instead of a sales call, right? I think most people, when they, there's different levels of communication, like cold calling is like trying to sell a timeshare, right? It's horrible. And having a conversation with somebody who in your sphere, or somebody that's worked with you in the past, either bought or sold a house, or maybe it's somebody that was unsuccessful that you tried to help buy or sell a house, right? These are easy conversations. And who thinks if you can find 10 to 15% of the properties that you look at make good financial sense, and if you called and spoke to 10 people, whether that's a day or a week, right? Most of us aren't talking to 10 people a week about investing in real estate. If you had 10 of those conversations, how many people do you think would be interested? Tony, if you talk to 10 of your past clients or your sphere, and you had 3 properties that were given a 15 to 20% cash on cash return, how many people do you think would want to come meet with you?
3.
Well, not everyone, but I mean, there are some people that don't have the funds, right? There are some people that, no matter what you do, they're not going to be interested. But so what, right? But if you talk to 10 and you found 2 or 3 that you can change their life, like if you have somebody with young kids, buy a house. It's probably the only thing that'll keep up with inflation for universities, right? So buy a house, sell a house when your kid goes to school, give them the gift of no college debt. So you could fund college buy a $400,000 house for 80 grand, 20% down. Then when they go to college, you can pay for their whole college and probably have some money left to boot. And make money along the way. So Tony, you half, a third would be interested?
I would say probably 2 to 3 out of 10 would be an easy pick.
Now hold on. I'm going to mute everybody that didn't come here for a second.
You just muted yourself.
I know. I was just picking on the people that didn't attend. I just said, isn't calling people that you know and trust a lot better than calling leads from Zillow or calling expired where, people are predisposed to hang up on us, right? But if you're talking to people that are in your sphere, people that you've done business with over time, and you just wanted to educate them on what's available, right? And I have I have a closer here in terms of how I'm going to get you to be really motivated to do this, right? So let's imagine that Lauren and Lynn, you both have clients that are in the same sphere, right? Lynn, you educate your clients about buying a piece of real estate. 5 years down the road, we're at a cocktail party, and your clients meet meet Lauren's clients, and they're saying, "Oh my God, Lynn changed my life. She introduced me to buying investment property. I had my money sitting in a CD at 0.5%. Now I'm getting 18% cash on cash return, and the properties are going to be paid off in 10 years." And Lauren's client goes, "I never heard of that." Are you really the professional you hold yourself out to be? Think about that, right? So you're really, it's like a doctor not saying that, if you break your arm, they put a cast on it, but they don't tell you how to stay healthy, right? You have to eat better, you have to cut down on your sodium, you have to do all these things, okay? But it's being that reactionary person when they raise their hand, I need something, but you're not telling them, hey, here's something available. We all know that there's a lot of cash out there because people are pulling money out of the stock market in droves because they're afraid, right? Okay, who knows what the formula is that creates the value of a stock, right? But do we know real estate? We know that real estate has inherent value for a few reasons, okay? One of them is if you're doing an appraisal, you look at replacement cost, right? Replacement cost going up, right? Are we seeing a lot of people putting their homes on the market because they have 2%, 3% interest rates? Do you think that's putting a headwind on inventory coming in? So if there's a headwind on inventory, is that going to support prices? So if there's less inventory coming on, prices are going to go up because there's still people who are coming to the life stage where they need to buy a house, right? And if there's less inventory coming on, then that's going to support prices. Okay, even though interest rates are up, because I'm seeing prices being very sticky. Okay, if you were to give me the factors that rates were to almost triple, go up 2.5 times, okay, housing sentiment would be negative. When you mentioned housing a year and a half ago, everybody's, I made so much money on my house. It was crazy, right? Now you talk about housing, it's like going to a funeral, right? I mean, are buyers, thrilled, or are they buying because they need? I think they're buying because they need, right? There's no longer that enthusiasm, okay? But anybody ever hear of Warren Buffett? Everybody heard of Warren Buffett, right?
Yeah.
So
Who's he?
Warren Buffett says, be afraid when everybody's greedy and be greedy when everybody is afraid. Right? And I would have this, like this stuff I'm giving you is good stuff to talk to people, right? Because when everybody was greedy, that's when you should be afraid to be there, right? Because you're buying a house, Lauren, no home inspection, no mortgage contingency, right? I'll give you my child if you give me this house, right? Now you can get a mortgage contingency from, are anybody not getting mortgage contingencies now when you're making an offer on a house? Is anybody not getting inspection contingencies? Were we not getting them a year and a half ago?
Nope.
Right? So is it now a safer place to buy? A more sane place to buy? Right. So I am passionate about what I'm talking to you about. And I did it first because I wanted us that live in the real estate planet here, that work with real estate, to step out of the blinders that we're in and say, look, let me make an extra sale or two and let me buy an investment property every year. And then over 10 years, you're going to have a significant amount of wealth. And if that works for you, let's share that with our clients. Let's share that with our friends. Let's share that with our sphere of influence. And the worst thing they can say is no. But Lauren, at that cocktail party, if you never told somebody about that and Lynn did, how do you feel? You feel like you feel really, really bad if they came and say, Lauren, Lynn's clients, they own 7 houses here, and their kids' college is paid for. I wish you would have told me that. So if you're not doing that for personal gain, do it for the fact that you want to have your clients ever second guess and say, why didn't you tell me? Right? Because even if they don't want to do it, do you think they appreciate the fact that you shared with them a couple of investments that can get them a 7% return before appreciation, or a 17% cash on cash return? And then, you know how you figure out the appreciation factor? I'm going to tell you, this is another thing to write down. You ask them, say, in 10 years from now or 5 years from now, what do you think? What do you think that this townhouse in, East Delray is going to be worth? How much is it going to go up in 10 years? And when they tell you, then you just plug the number in, right? And if they say, oh, I think it's probably going to go up 10% a year, let's just pretend it only goes up 5%. It's a ridiculous investment if it goes up like that. And if they say, I don't think it's going to appreciate at all, guess what? This is probably what? Not for them, right? If they don't think real estate value in 5 years is going to be higher than today, maybe this is not for you. Maybe buy a treasury bond at 3%.
Show them income. Value.
Right, but we're
but you're buying it for the future, the income, paying down and having a free and clear asset that
right.
You can borrow against and leverage against and buy more property. It's not always about the actual value of the property, right?
Yeah. So there's cash flow, and then there's, in real estate, there's an inherent value, right? If you were to go buy Salesforce stock, right? Do you think that the people who trade Salesforce stock care if they own the property that they're in? Okay, they don't care about that, right? So if their whole business model fails, like, what is there to go to? Nothing. Your stock can go to what? Zero. Wallpaper, toilet paper, whatever. But if you buy a piece of real estate, there's an implicit inherent value there.
Right.
Okay, then there's a cash flow from that. Then there's a tax benefit from it. Okay, and those conversations are far, far easier than calling Zillow leads, calling expireds, calling FSBOs. And who in this room has been having these conversations in the past week? Anybody? How about the one person? You don't count. The past attorneys don't count for this. The past month, has anybody been talking to their sphere and their clients about it? We have one person. The past year,
I have.
we have three people.
Rob, I have a buyer right now that I'm taking out in Trenton. We're doing investments. We're about to put in 2 offers today.
Right, but how many people are in your phone as contacts?
As far as real estate contacts, close to 100.
So Maurice, no, in contacts, people you know, friends, people who would take your call.
Well, I know
how many people are. Would it be safe to say probably at least 300?
Yeah, I know a lot of people. Yeah.
Okay. My question to you, Maurice, is how many of those people have you had this conversation with?
Okay, that's a good question. Probably
Because
less
my guess is
less than a quarter. Probably a quarter.
My guess is not enough.
Yeah.
And we're all chasing the same shiny object. We're trying to be a peacock to people that don't know us, right? Say, let me go sell you a house, and everybody else is chasing them. And the more people chase, the more they push back, right? Then we have to get better at our scripts, better at this, better at that. But when the gold is right underneath us, right? So if you're selling Teslas and you drive a gas guzzler, you got a challenge, right? If you don't believe in what we're doing here, right? And, I would say, let's make it a goal. And this is not for me, this is for you. Make 2 extra. Who can make 2 extra sales a year, right? Could you take that money and buy an investment property, or at least, make 4 sales and buy an investment property, have that down payment fully funded? Why aren't we doing that? And the irony here is those sales might come from you educating other people on what they could be taking advantage of, right? So I hope this was helpful. I know we're like 3 minutes from the end. The 3 things that I would be talking about would be cash on cash return, cash flow, annual return, appreciation. Now, with the cash on cash return, I'm going to go back to Lauren because we started this discussion. It was a 17% cash on cash return, and Mr. Turner's paying $900 or more a month down in principal because it's a 15-year. That's an extra $12,000 of real return, right? Because that's like putting it into a 401k. It's for savings. So in Mr. Turner's case, that will take it up to about 31% cash on cash return. And then when his rents increase, okay, that's going to be an extra return, right? And then if the property value goes up, that's an extra return, correct? Plus, he has the tax benefit of having an accountant that's going to depreciate something that's appreciating. And when he sells it for a profit, he pays less taxes. What more could we want, folks? So who's in for making 5 conversations a day for the next month?
Thank you, Rob. Including myself, I'll be purchasing.
Pavla, you're unstoppable.
No, thanks to you too, because, I have not thought about it. So I'm just going.
But Pavla, that's the point, right? We're all so busy doing what we think we should be doing.
I got my prospecting. Yeah, I missed the big picture. Rob, I have to go. I have another mastermind. I don't mean to be rude, but thank you so much.
All right. Okay. Bye-bye. So any other questions? Yes.
Just a quick thought to cover ourselves, because we know real estate is litigious. should we not have some disclaimer at the bottom stating that these are estimates only based upon costs provided or something? Because if someone's relying upon the information to make the investment, they could then hold us liable saying, well, I bought this assuming a cash on cash.
We have an attorney in the room. Come on up here.
What was the question? I really didn't hear it well.
It's a plan.
So this is Josh. And we have, if you came here in person, we have bagels and a little bit of food here from Courtney and Christian, who are going to be our in-house title affiliate. Okay, we're going to be equity partners with these very capable and qualified folks, and Josh is going to be the in-house attorney. But that really was a setup, Lauren. I appreciate it.
Yeah, so first, answer your question. A disclaimer is always good.
What was
but
the
it's not-
question? We didn't hear it.
Oh, sorry. She asked if you're using comps with a client and they're going to rely on those comps, and then something goes different. The market changes. Should you put some type of disclaimer on the comps to reduce or eliminate litigation? And it may reduce it a little bit if someone reads it. At the end of the day, it's not going to stop litigation and it's not going to really protect you against litigation, but you don't need it because they're comps. You're not promising, spreadsheet. Yeah. You're not guaranteeing a future return. You're not guaranteeing future value. It's an investment. And if there's any disclaimer, it's like with any investment, there is no guarantee. Some go up, some go down.
So the one,
except for real estate.
The one thing I would just say is, you know, there's nobody in this room that fits this category, but if you're purposefully manipulating things for the purpose of making a sale, the problem is you're not in this room right now if that's your intent. But that would be something that would be problematic to me, but I'm not concerned about you saying, hey, this is based upon 3 other rentals, what it's going to go for, right?
And if you did manipulate it and put a disclaimer on there,
it's not going to
protect
protect you.
you. It doesn't matter. Can I have a second?
Yeah.
I'm Josh. No one can see me, right? They could hear me. That's good. My name's Josh List. I'm an attorney, licensed in Florida and Georgia. Been doing real estate closings for 20 plus years. I want to thank Rob and Fazia because they've made significant investments in everyone that is either on this call or in this room. I've seen some of it. I'm not talking just financial. There's time and energy, mental, physical. They are here to help everyone succeed. And I appreciate that personally. As far as Iconic Title goes, I'm working with Christian and Fazia and Rob to create
and Courtney.
Well, I was going to get to Courtney in a minute, but to create a seamless closing experience for your clients. And in addition to that, we want to add value for you and for your clients. And whether that's through effective communication, streamlined communication, closing at convenient locations and times, having access to an attorney if you or your clients have questions or need something in regard to contracts, leases, landlord tenant, wills, setting up new companies, pretty much anything that's relating to real estate closings and real estate, we can address it. And if we can't, then I have a network of people that can. And the only other 2 things I wanted to do along that line is for the people here, I'll introduce you to Shelly in my office. She's sitting right here. And then Courtney also. And between the 3 of us, we are available to every one of you. We'll make sure you have direct contact information for us. And anything that is going on, you contact us and we will address it. like you guys, we don't make a living off not closing deals. The deals have to close. And I can't promise you that there will never be an issue. They will be few and far between, but when they come up, you're one phone call away from it being resolved, addressed and resolved. And so the last thing I'm going to do is reiterate what Rob said, and that is that real estate, people think real estate goes up and down. It does.
But thought it would be
I'm sorry?
Then try Babbel. 15 minutes a day. You'll be speaking a new language in a few weeks.
People think real estate goes up and down, which it does. But the reality is real estate goes up. You just have to be able to carry it when it goes down. I'll give you one example and I'm out. Meisner Park in Boca Raton, 15 years ago, you could get it for 60 million, 10 years ago, maybe. Right now, I believe Michael Dell and a couple other people are bidding on it for 350 plus. I think it's going to end up probably closer to over 4. That's a 500, 600% return in 10 years, 50% a year. If you can carry it through the down and have the assets to purchase when, as Rob said, everybody else is scared, real estate is the investment. So thank you guys. I appreciate it. We'll make sure you have all of our contact information. Anything we can do to help you, we will.
Please stick around afterwards. Would it be helpful if next Tuesday, same time, I'll come on and you can actually play around with it, and then you can ask any questions. People can watch your questions and maybe even give us some feedback to the conversations you made over the past week. But Lauren's never going to go to that cocktail party and have a friend of hers not know about it. I guarantee it. That mental image is that's harsh, but it's a reality, right? It could be, and it's not about shameless selling. It's not. It's about, hey, I just want to let you know I'm personally interested. I value you as a friend, as a client, as a potential client. I just wanted to share with you something that I saw. If you're interested, great. If not, I just want to make sure you're aware of it, right? How could that call not go well, right? Especially the people that are in your phone. For crying out loud, call them, let them know. So next Tuesday, 10 o'clock, only via Zoom. I may do it in person in Westfield, but via Zoom, put the questions in. I'll have everybody on our Abundance in Real Estate page. I'll put this recording there and I'll put a link to the spreadsheet that you can go on and copy. It's purposely going to be not editable to you so that you make a copy so that you don't have it and then you change Lauren's and she changes yours, because that'll make a lot of calls. But copy it, own it. If you're not good with Google Sheets, talk to your manager, talk to me. We'll get you comfortable with it. And let's spread the word. Any last questions?
May I ask you a question? May I ask a question?
Yes.
Because I'm a new agent, so when I look at the spreadsheet, okay, I saw the cap rate one is 7.14 and the other one is 7.54. So how come the annual return, the 7.14 was 29.45 and the other one was a negative, given the cap rate was higher?
That's an excellent question for a new agent. So a property, as long as it has positive income, is going to have a cap rate. But if the cost of capital is more than the return, then you'll have a negative cash flow or cash on cash return. Because part of the cash on cash return is your forced savings of paying it down. Okay. But if you had a property that cost $1 million and it only made 20,000, if you took a mortgage for 80% of that, your mortgage would be 60,000, you bring in 20, would have a negative real return, but it would still have a cap rate. So that's what makes the difference. And that's why we're going through this exercise. I think that was an excellent question. Anything else?
Thank you. Yeah, another question is, because for right now, it's so hard to find someone that were like over 7% cap rate. Do you recommend it if we find something like zooming house, let's say 6 or 8 zooming house, which they have like 10% cap rate?
Are you talking about, you're saying a rooming house?
Yeah.
I would stick away from that. I personally, I don't think that's like a hospitality industry, not a real estate play, in my opinion. Can I and your first name, who's talking?
My name is Sandy.
Sandy.
Yeah.
So what I'm going to tell you is remember, 85 to 90% of the properties I don't think fit this bill, right? So, but there's 10 to 15% that are going to be really good investments. And there are different reasons why, because somebody might be renting it out and they haven't changed tenants, they haven't adjusted the rent upward, right? Or maybe you can buy a place for 500, put 50,000 into it and get a rental return of something that's $750,000. These are the reason why we exist, right? If these weren't things that needed a real human to do, an algorithm would be replacing all of us, right? Artificial intelligence would be taking our job, but it's not happening because we have to take the time, and it's not that much time, to evaluate some stuff. So those are both great questions. Anybody else before we wrap? So when is the next, Lynn, when's the next meeting? 10 o'clock. You got it.
So look, if you find a bunch of property and doesn't get a 7% cap rate, should we like just make a bunch of offer and to see anyone, you know, like let's say if the house they were putting listing price for 700, and if we want to get 7%, they will only have 600. If we over 600, so that's kind of like making them mad about it. Should we still make the offer?
So I'm going to ask anybody in the room. So the question was, if at the offering price of 700, things don't make sense, you think it's a good strategy if the properties are around 700 to make offers of 550 and 6 and go around and make a ton of offers, or is there a different strategy? What do you think?
Different strategy.
I would agree it's a different strategy because you'll burn yourself out. You'll be toast by making these lowball offers. And I think it's a recipe for disaster. I think you need to be a sharpshooter. You need to identify some properties that have some characteristics that are going to give you the ability to expand the return without having to invest a lot of money. Does that make sense?
Yeah, and cap rates change based on the environment. And what I mean by that is in certain environments, 7% is expected. In other environments, cap rates closer to 4 or 5%. So if you're trying to force a 7% cap rate in a situation where the going cap rate is going to be 4 or 5%, like you said, you're going to bang your head against the wall and not really get where you need to go. So it's something to keep in mind, something to consider.
Is Greg Morozek, are you still on or did you drop off? Greg?
Got it. Thank you. Thank you.
Okay. Thank you. The last thing I would say is we had somebody who had his client buy a property and there was a subdivided lot on it. So he bought the property, he sold off the lot, he put 20% down on it. The mortgage was only on the residential unit. He sold off the lot, got half of his money back. So that doubled his return. So these are things that you have to just be aware of. And that property was on the market for 92 days. So it's not like, you know, it was a secret deal. He just had the vision to look at it and say, hey, Josh, what if I did this? We'll say we're paying $1,000 for the lot. We're paying $500 for the building, right? So the mortgage doesn't go on the $1,000 lot, but it has to close simultaneously. And then he put the lot on the market for $100 and sold it for a net of $80.
All day long.
Right? So those are out there all day. You just got to look. Thanks, everybody. I'm going to stick around here for the in-person meeting. This recording will be posted up on the hub, and I'll put the corrected sheet that you can copy on there. Thank you, everybody.